A great question about why, you're talking about my good friend Peter Thornhill, why ETFs versus LICs. This is largely historical, and of course Peter's almost 20 years older than me, so he's been around quite a bit longer. And his background goes back to the days when the two choices of investing were managed funds and listed investment companies. Managed funds, unlisted trusts, where you bought it directly from the fund manager. So in the old days, you would get a PDS in the mail, you'd rip out the application form at the back and attach your check and mail it off to the fund manager, and you get your unit certificate back. And those units were always worth the value of the underlying assets. So they always traded at net tangible assets, and they traded once a day. Very convenient. Downside from a fund manager's perspective is that money comes in and out, so you need to maintain some liquidity. The solution to that problem was to create the listed investment company. And in Australia, that was the dominant place. So some of our LICs go back to the 1920s, so some of them are very old. And the listed investment company solved the problem from the fund manager's perspective, where it gave a fund manager a fixed pool of money to deal with, and people who wanted to move in or out of that fund sold their shares to somebody else rather than cashing them in. And that all works really well when there's a balance between buyers and sellers. But when you have a preponderance of one or the other, so there's a preponderance of sellers, so more people want to sell than buy, the price will fall. And it gets out of whack with the value of the underlying assets. And so LICs usually trade at a price that is different to the value of the underlying assets. It's either a premium or a discount. If that premium or discount stays the same all the time, then it probably doesn't make a huge amount of difference, other than you can buy, if it's trading at a discount, you can buy $100 of assets for $90, and you're then going to sell them for $90 for what they're worth. So you do get a bit of an uplift in return. But the problem with LICs is that you have to, not only do you have to worry about the value of the underlying assets, but you also have to worry about the premium or discount. And quite often the move in the discount or premium can overwhelm the change in the underlying assets. So it's a much more complicated performance analysis to do. And the ETF came along and effectively solved the problems of both. That it created a tradable instrument that people could buy on the stock exchange that would always trade at or about the value of the underlying assets. And because most of the trades were between existing holders, it gave the fund manager a fairly stable pool of money to invest. So liquidity was less of a problem. And where you have an excess of sellers, which would otherwise drive the price down, the market maker will exchange units for the underlying assets. So if they've got more sellers, they can actually take the underlying assets and redeem those units, and that keeps the spread away. So the ETF solves the worst of both assets. The other argument that people, so therefore from my mind, ETFs are to be preferred just structurally. The second point about ETFs is that they are generally more efficient from a tax perspective because they generally don't trade much, they're very low turnover, and the movement in and out by other investors doesn't create a tax problem for the remaining investors. So tax efficiency is the second point. And the third point really is that they can actually work at relatively small volumes. So you don't need $1 billion fund to make money, whereas a small managed fund can be expensive to run. The other argument that's run in favour of LICs, and Peter runs this argument quite a bit, is that because the manager can choose not to distribute all of the profits each year, they can retain them, that you get smoother distribution. That's true, but it doesn't change the overall return. It just changes the timing of the distributions, so that should all wash out. There have been some tax reforms that improve the problems of ETFs, of LICs. LICs, unlike trusts, are taxpayers in their own right. So when they make a profit, they pay tax on it. And in Australia, it's partly okay because they then distribute franking credits. So some of the better franking credits actually comes from tax paid by the vehicle, and not all. And the other problem they had was when they realised capital gains. Companies generally don't get the capital gains tax discount, whereas you do. And so there was a tax difference. That's been fixed a little bit with the LIC tax offset. I just think the overall complexity isn't rewarded. And if you look at the returns on the big funds, AFIC, Argo, they're not materially different to the index. Peter's other argument, which had some validity in the heady days of the nickel booms and the Poseidon scandals, and even the 80s entrepreneur scandals, where the LICs tended to be more blue chip. They tended not to invest in miners, and Peter's not a big resources fan. But that's an argument of what you're investing in. So would a financials or a ASX 200 X miners ETF satisfy Peter? Maybe. But I'm not a fan of LICs generally. I think it's just too complicated. They were a great solution. In fact, they were the only game in town for most people, and stockbrokers loved them because they could earn commissions from their clients, whereas if you invested in a managed fund, you might not be able to. Peter's a great guy. He's been around even longer than I have. He does have less hair, but I think he's wrong when it comes to LICs.